Well, people, the mood of the market is straight up like a rocket ship. That's what we're going to be talking about on today's Stock Market Brief show. Can you take me higher?
Can you take me higher?
Yes, the inflation data came out today lower than expected by a little bit, and the market shot up to almost reach a 3 standard deviation move, which is a very rare, getting outside of the weekly expected move and well outside of the daily expected move. Now, before we get into everything, I want to just add a piece of advice, an unpopular opinion, some may say, because while I'm out there on FinTwit, or as you call it, FinX right now, I've been seeing a lot of emotional posts about criticizing bears or criticizing bulls, or you should be doing it this way, or you should be doing it that way. Let me just tell you a cold, hard fact, and that is that you should really never let a losing day or a winning day dictate your overall happiness. If you're overly excited or if you're overly emotional, chances are you're not positioned correctly. So when you see people overly excited that they made some money, chances are they took a huge risk that they couldn't afford to lose if they were incorrect. Well, if you're positioned incorrectly and you can't handle your portfolio's volatility appropriately, that typically means that, you're either overly excited or heavily emotional and you're not in the right space. Okay? Now, I made some money today, but in my opinion, it's like, okay, so who honestly cares? So what? Big deal. If I lost money, I'd honestly say the same thing. This is a long game. Remember, it's not just one day makes or breaks you. Yes, I know that that's what Hollywood wants you to believe, right? And that's what like everyone, all the good stories are. You know, you make one big break and then it's like all uphill from there, or all whatever. This is a long game. Be focused on your process. Be happy with sticking to a process. And if you had losing days, who cares? If you have winning days, who cares? If you're sticking to a process that's consistent over time, you can make some money. All right. Now, if we take a look at the heat map, ooh, it's green everywhere across the board. It's green, other than healthcare up there. But yeah, everything lit up. You can look at the 11 sectors that make up the SP 500, all up in the green today. Now, I want you to pay attention to what led the way. Utilities and real estate. Why? Why would utilities and real estate lead the way? Well, yesterday we discussed that today's economic data that reported the CPI has a big impact on the bond market, on yields. And what are these two sectors have in common? They are very rate sensitive, both utilities and real estate. What happened to the 10-year yield today? The 10-year yield broke down from that channel we've been watching. Now, it's still a higher low as it stands. Okay, but it broke down from the channel. Some might notice that this is a head and shoulders pattern up here. So a measured move could bring us back down to around 4% on the 10-year yield to 4.1% on the 10-year yield, which could alleviate, obviously, some moves in the market, right? The market seems to be responding well as the 10-year yield comes down. But we'll see if that move continues. We've been talking about the negative divergence on the price momentum oscillator. We talked about the negative divergence on the RSI, and we warned about that as a potential outcome. Well, today, on this rate-sensitive macro data drop, it dropped 4.12%. Okay, so that's a big move in the 10-year yield. If we take a look at bonds, what took place there? Well, the TLT took off like a rocket ship, 2.27% for the TLT. Now, that actually outperformed the S&P 500, that outperformed the NASDAQ 100 too as well. And you can see Dow was up 1.43, S&P was up 1.91, NASDAQ Composite was up 2.37. Actually, let me see here. NASDAQ Composite was up 2.37. So it didn't outperform the NASDAQ Composite, but it did outperform the NASDAQ 100. What's this right over here? Oh, that's the IWM, right? There were small caps, which we'll talk about the IWM here momentarily, because that thing was up a monster 5.47%. If I take a look at the yield curves, we actually inverted deeper, right? We're over 100 basis points inverted. This thing shot right back down. We know that when this thing inverts deeper, it typically adds some relief to the market for whatever reason that may be. But that has been the case, and we've been sharing a chart with you. I don't have it with me as of this moment, but I'll continue to share it as we progress further. So if you haven't done so already, make sure to subscribe to the channel to get that data. If we take a look at the dollar took a big hit to the downside as the market moved big up to the upside. We've been talking about the negative correlation here. As the dollar drops, it helps the S&P 500. If this dollar rose by a large move today, I'm sure that would have damaged the S&P 500, but quite the opposite happened as this thing, I mean, look at the length of this candle. That's a big authoritative move to the downside, breaking down from some key levels. So where can you potentially watch this to fall to? Maybe 103, which could alleviate to see some more upside in the S&P 500. If we take a look at the SPX on the weekly time frame, we're getting pretty far extended from the weekly 5 EMA. Remember, when we're extended from it down here, we talked about it, and you typically see what? Snapbacks to the upside. Well, we saw a snapback right to the upside. When you get snapbacks to the upside, way above the weekly 5 EMA, you get snapped to the downside. When you get to the downside, you get to the upside. When you get to the downside, you get back to the upside. Well, we're back up to the upside. So as this continuing to move up, there's going to be a time where this reconnects with the weekly 5 EMA as it's most frequently tagged EMA. So it's something you could consider. And also, while we're looking at that, we're well above the monthly expected move, not too far off the quarterly expected move as the quarter just recently started. That'd be right up there at around 4,600. If I take a look at something like Qs, we're also busting through that monthly expected move, and we're not too far off the quarterly expected move there at about 390. Now on IWM, when we reach down to the quarterly expected move, the lower quarterly expected move, we actually talked about it on that day. And we said, if you're looking for opportunity in the markets, from a probability standpoint, this would probably be it. Well, we're up 8.47% from that move. Yes, I took a long position. No, I didn't hold it all the way to where we are today, but I used leverage and it helped out tremendously, so I cannot complain overall. But yes, we are clearly making a new high on the month there. Now, yesterday we talked about how it was flagging into the golden zone to watch for a move back above the week to date. Unfortunately, I mean, CPI data, I mean, you can't, so why it's binary. It gapped way up. So if you caught it and you play the move to the upside, like I wouldn't short right here, right? Well, it bounced, moved up further to the upside. You don't want to short a strong move like that. Okay, but we are right beneath the year-to-date anchored VWAP. And what I find interesting about this move that you're not going to hear many people talk about, right? I thought no one was going to talk about it, but some people proved me wrong. They did talk about it up on Twitter, okay, or X or whatever. So the IWM was up, over 5%, which is a monstrosity of a move to the upside. Okay, when we talked about this one yesterday, but take a look at Russell Volatility, right? Russell Volatility was up 5.38%. Now, this is okay, all right, but what I find so interesting, it's just weird. It's weird to me because Russell Volatility was up, and the Russell was up so much, and typically you get volatility subside while the market moves higher, okay? And this could be because we have retail sales numbers coming out, I believe, tomorrow. Yeah, retail sales tomorrow, and that could impact the IWM, so it could be just kind of that puffer fish type mentality where implied volatility kind of swells up. That may be the reason why, because if you look at the VIX volatility, this was down 4% while the index went up. And if you look at NASDAQ volatility, that was down while the NASDAQ was up. So this was kind of interesting to me overall. And one thing that you want to pay close attention to is it doesn't necessarily mean this goes up, IWM goes down. It means that we can see larger swings. And typically when you get larger swings to the upside, you can see larger swings to the downside. And vice versa, if you see large swings to the downside, you can see large swings to the upside. That is volatility, people. And we're kind of in the midst of that right now. So I'd say be careful chasing it up here. I'd say a potential target could be up to the year-to-date anchored VWAP. And in the short term, it could potentially go higher. But in the shorter term, you can maybe look for a reconnect of the week-to-date anchored VWAP, or potentially just a pull down to around this prior this low over here where this previous high was, that'd be more than, possible there. We've seen some big red moves, right, to the downside, but it's followed through upside overall as it stands currently. Now, if we look at the NASDAQ bullish percent index, this RSI is now moved into that overbought condition. The index itself is rather low. Remember, overbought can stay overbought for quite some time. I like to look for those negative divergences, very similar to how we found the positive divergence here that led to this market rally. The BPNDX is also moving into that overbought condition. Same theory applies there as we look for those divergences. The SPX cranking into that overbought condition at 76.57 on the RSI, but there's a lower reading as, prior we were up above 80 and we look for a cross below 70, so we're still low there, but just be aware that we're reaching into that territory now. The NYSE bullish percent index reaching into that overbought condition as well. BPINFO finally reached into that overextended territory too, and this is reaching into a higher level. The higher level that we've seen prior was 90, and we called that out with that negative divergence as the RSI was putting in a lower high, but this index was cranking. So we're like, yeah, this could be very well an area where you look for a top, and sure enough, we started moving back down until we got into this oversold bullish divergence type of state. If we look at the discretionary ETF, right, S&P Consumer Discretionary Bullish Percent Index, also moving into that overbought condition. If we take a look at the NASDAQ Summation Index, we've now been 8 trading days on the buy signal. I love this indicator. It helps identify potential changes in trends. Sometimes you get short ones, but others you can catch longer term trends. And this one, so far, it's playing out pretty well. We actually called out the bullish divergence in the NASDAQ McClellan oscillator multiple times. This led to a pretty nice rally, but now I want to call out, well, the market's pressing higher. Okay, all is well, but we do have a high and a lower high as far as the internals go in the NASDAQ McClellan oscillator. So that is a negative divergence forming. Now, if we take a look at the NYSE Summation Index, a more broader index here too as well, we've also been on that buy signal for quite some time. As the market continues to press higher, you see a high, a higher high. We have a high and a lower high in the NASDAQ McClellan, or sorry, the NYSE McClellan oscillator. And I can show you this. If we zoom into the NYSE McClellan oscillator, we've seen this red, all those divergences, but we call that multiple positive divergence that led to a rally here, a rally here, a rally there, right? Well, as it stands, we saw a nice big move to the upside. Doesn't mean that's the end, but we have a high and a lower high in that reading where we have a high and a higher high. So just be aware, we may be in for a period of digestion. What you'd want to see is this to turn back down. I'd love for price action to move higher and this to turn back down, because that would indicate a clear negative divergence that is potentially going to play out. If we take a look at copper, copper was up slightly on the day. Nice big bounce overall. Guess what? SP500 is following. We do have a pretty large topping tail here. So if we look at the close over here and the close right down here, that is a pretty significant lower close versus the close right here. And well, the close right here is a significant higher close, obviously indicating a negative divergence in the price of copper, Dr. Copper, to the S&P 500. We've talked about negative divergences over time and positive divergences that led to rallies and both, obviously, turning points, even to the downside in the market. If we take a look at the SPY, this was the big test we're paying attention to. Well, we gapped and cleared that like no tomorrow. So a potential area of support would obviously be the gap fill. When those windows are closed, they can act as a potential area of support. So that can be something to pay attention to. Obviously, if price were to come down here at some point, look for that month-to-date November anchored VWAP to come back up. Now, we talked about 450 as a potential target area. Did I think it was going to hit it today? No, but it did. It tagged it and it backed off there ever so slightly. So the next area to obviously watch is going to be the 2023 swing high. If we take a look at the chart that we posted yesterday, we talked about this 4450 call wall at 185 million for gamma exposure. And this is why I find this to be so interesting, okay? And I want to point this out. As price moves closer to it, it could get pushed away. But what happens if price opens up above it? Well, the same thing. It can push price away. And take a look where price opened up today. It opened up at 4470. 4450 was that gamma exposure level. And what happened? Well, dealers dynamic hedging takes place. Price just push. Even outside of the weekly expected move, you have a subtle pullback, price pushes up, a subtle pullback, price pushes up, to where there's a big gamma exposure level there that started at 4,500. If we zoom in, we're above the weekly expected move as it stands for the SP 500. Daily expected move is going to be up there at 45.24, 44.67 to the downside. And then we have our local resistance at 4,500. So if we get above that, that opens the door to 45.15. Local support is right over here at about 44.90. This is that gamma exposure level. If we break down through that, price can push down further. I'd say pay attention to 44.80, which is about that weekly expected move. Remember, if you're looking at weekly expected moves in terms of probability, 68% of the time it closes within them, but the options market has been getting it wrong, very wrong as of recent trades. So just be aware that this is a very volatile environment, so you got to be careful, keep your risks tight, and pay very close attention to key levels and honor your stops. That's all I got for you on today's episode, everybody. Hope it helps out. See you later.